We're going to go ahead and dive into Chapter 7 as we go into Schaeffer's investment research. Let's go ahead. Let's bring on Matthew Timpane here to dive on in. Like I stated a little bit earlier, is a CMT, so definitely has my respect. Welcome on, Matthew.
Well, nice to see you again, Mitch. How are you doing today?
It's good to see you on. I'm really excited to dive into your presentation today, and the markets are moving. Looks like the minutes got us moving again.
They are. You saw those lows at that 1500 tick earlier today, and it's kind of just been off since then. I mean, it was a little more muted, but now it's coming back strong after those minutes.
I got to say, I like the background there. The crazy bull there.
Yeah, I'm back in the office right now, so I had to find a little hole. So I found our podcast room and hold up in here for the presentation.
Sounds good. Let's go ahead. Let's dive on in. I'll bring up your slides here, and we'll go into directional strategies. Anyone can trade?
Yeah,
some direction right now. Let's take a look.
Yeah, so I just wanted to do something, just show some directional strategies that anyone can trade, things that we do here at the firm. So, let's just kind of dive in to that. And we always try to provide a little bit of a market update going forward. We're seeing a lot of short squeezes right now in the market, and it's really kind of been one of the biggest melt-ups that we've seen, right? Like since 2020, and one of the biggest in my career. It's only been a little bit over a decade, but still one of the biggest melt-ups that I've experienced. And this is really just due to the unprecedented amount of negative sentiment and increasing short positions that we had built up earlier in the year. In June and July, we were seeing all these signals. And then, also there's all these multiple breadth thrusts that have triggered like a 95% reading in advanced decline and percentage of stocks at their new 21-day highs, et cetera. You can just go out on Twitter and you'll find a slew of positive breadth. Literally just type in breadth thrust into your search. And this is really positive for longer term normally. So I normally would have some charts to show you on this, but when I transferred my data to a new trading rig, I encountered multiple corrupted files. So still working on getting those files back here so I can show some more breadth studies. But where are we? We're likely at another major pivot. It's almost too obvious, but bulls have hurdles they have to conquer on every rebound. This is why we call it climbing the wall of worry. And the last time I kind of was here, we spoke about an expected move up to at least 400, and that's where they'd have to make another decision. Obviously, we blew through 400. They made a decision that was much higher, and now we're kind of at this next major pivot area where we just kind of want to stay nimble and we want to trade what the market gives us, right? Late cycle signals, they're kind of dissipating a little bit. Healthcare staples, they're still holding their own, but really we've been seeing big movements in discretionary technology, communications. The one surprising thing was utilities is up 11%. That's right up there with energy, in materials, and biotech even. So that's one thing I would like to see kind of leg the more cyclical sectors to going forward to kind of hopefully ensure that this bull market is continued on from the bottom. So the Fed pivot, they've clearly indicated that they don't really have the markets back, but they have indicated that they may reduce their rate increases. So CPI data came out slightly lower than expected. Kind of view it more as a stall out, but I still think the Fed sees it as a huge major opportunity to kind of build some leverage in for future rate cuts. So the one reason why I think that they're looking at possibly reducing that rate cut increases is because we have this 3-month curve. It's sitting right near the inversion level. That basically all but solidifies that a recession would be on the way when you look at it from a macro standpoint. And even the tens and twos, right? The tens and twos now are the deepest that they've been since the year 2000. But like I was talking about last time, you see some of the biggest bear market rallies in these type of situations. This is where you get those 20, 30%, even 40% rallies in them. So that's at worst, that's what we're in right now. And that's not a bad thing to be in. As a trader, you're able to capitalize on this volatility, whether it's to the upside or to the downside. For longer term investors, it can just kind of be a tougher spot for them. But so right now it's just don't be complacent, give what the market gives you. When it changes directions, you got to move with it. But that's kind of where I'm at on the broader spectrum of things. And that's where we're at as traders, right? So from the seasonality perspective, it fell right in line with what we expected, right? You're going to get a rally in July into August. I use the analogs from, past where price action was very similar. Also, inflation data was very similar in these years, and we got this move. Now, from a seasonality perspective, markets can stall out anywhere from here to October, so you can't base your trading strategy just alone on this. And August, has kind of a standard deviation move of around, I believe it's 4.32, so slightly higher than normal. So we go into September. Obviously, everybody's going to be talking about how it's seasonally bearish, and it is. It's on average down about 0.5% since 1950, and that also has a higher than normal standard deviation. October, I believe, is the highest for swings, but it doesn't mean that we necessarily tank again. It could, but it doesn't necessarily mean. We definitely have seen years where you have 1982 and 1970, where if the presidential cycle and the new bull market cycle really hold true, we're probably in a bottoming phase where we'll probably see some consolidation, where 2023 then would be another big bull market. So let's go on to the S&P 500 chart here. Like I said last month, we talked about how the higher lows needed to test that 400 range, and that's where we'd have the big deciding factor. Well, we easily kind of broke through that range there at the 400. Now we're seeing a lot of open interest there at the put level. It's a large strike level. So we broke across these trend lines, and we've literally taken them out, climbing the wall of worry. And this was really like the logical standpoint, right, to pull back at. It was the 200-day coming into a trend line. We had this 430 peak call level right here for September. I've kind of moved on from August already on that. And you have this minus 10% level as well. So it was logical for us to do that. But when I think about logic, and when everybody's thinking about the same move, I don't know if it's exactly going to happen. The logic move is we consolidate back down to 415. But will that happen? I mean, I think, a lot of times markets like to overshoot. So if we do kind of gain some traction right here or even around 420, we could overshoot to this 437 area. I see that easily happening if that's the case. We could also, if we do go to that 415 area, we're probably going to likely overshoot a little bit down to that 410 area there. So, the biggest support level that needs to continue to hold for traders, if you're a big bull, is that 400 level. That's the area that I would probably get really worried about. And if we break through 410, we'd probably be magnetized down to that 400 level. And the other thing is, 433 is going to be a pretty decent level. It's the 1-year moving average or the 12-month moving average. We want to get above that. That really shows us that the bull's back on. Until then, we're still kind of just in no man's land, trading the volatility, which is great. Why did we have this rally? Well, net large specs, net position are now the most bearish they've been since June 2020. And they're still increasing their short positions. So as you can see just from the chart, they've been historically wrong. I mean, they even nailed the position in 2007 to be short, yet they gave up. And, by the time the bottom came, they were on the long side anyways, while they were still, the markets were still going down. So this rally could still have legs to it if it continues to hold technical levels. One of the biggest things we wanted to see was an increase in short interest, and we've seen that this year. The SPX components, so all the stocks we aggregate, the short interest in it, was really at a low level coming into the year. Kind of gave us some warning signals that, it could be a tough trading year. Obviously, it turned out to be a really tough trading year. But now we've seen a little bit of an increase, right? So, in the past year, we're now in the 75th percentile. And for the NDX, it's even better. We've seen a year-to-date change of 16% in short interest. And now in the past year, it's in the 91st percentile. So this is what you need to fuel bull markets. So these are all positive signs. It doesn't necessarily mean that we don't go back down to test those lows, but these are positive developments. And then, short squeezes, as I mentioned, you have the Russell 2000 small caps. They were still extremely shorted. They never really laid off the gas on those ever. So even coming into the year. So, we're still in the past 5 years in the 94th percentile. You just see recently that shorts have kind of come off those stocks where, we're down now slightly off the peak, but still year to date, we're up on it 12.5%. So that's part of what has been fueling that small cap range going on there and the low float stocks. And that's something that, can continue to happen. Got a little bit more data to show you here in just in a second on that as well. we always kind of pull up the put call volume ratios here for the buy to open on the components. This is aggregate data. Again, it's not index data. So this is all the components within them. As you can see, we kind of got a little bit of an unwind. The SPX was near its 2020 highs. The NDX ratio actually was near its 2016 highs, which was the highest level we've seen since then. It's even higher than 2020. And that was yesterday, I believe, settled at 0.67. So we saw a little bit of an unwind. But we haven't seen a full flush out yet in these sentiment indicators, like we have in Investor Intelligence, like we have in the National Association of Active Investment Managers Exposure Index. So, I'm not going to show those. This is kind of saying, hey, this is where we are. We're at a pivot. It can, kind of go back higher if it wants to and remain at these levels like it has in previous big bear markets. Or we finally get that final flush out and we kind of go into a big new bull market, right? And we move towards that excessive optimism side down towards 0.4, 0.3 area. So we're not quite fully there, not all clear, but these are, again, positive developments telling us that we're likely at a pivot point. And then now here is the IWM. So this is the IWM components. This is telling you that traders have been buying calls of individual companies within the IWM index. And, that has moved down now towards, 0.38, which is pretty low for the average, not extreme lows, but pretty low. Now, when we look at the index itself, we're seeing the 10-day buy to open put call ratio has risen to 3.97. So what is this telling us? It's telling us that, market participants that are participating in these short squeezes are still kind of hesitant that the bear maybe not over, right? And they remain hedged through index put exposure. So that's kind of what we're seeing right now. It's been an exciting trading opportunity, but let's get on to the directional option strategies that we're going to talk about here today. So we're going to talk about directional in the money trades and showing a couple examples, directional at the money, and then credit and debit spreads that we kind of do over here at Schaeffer's, and that anybody can really do on their own as well. And couple just tips here, just keep it simple. Don't use a bunch of indicators. Keep your charts clean and large. Trust me, trend lines and notes take up enough space on your charts. You don't really need to see you need to see the price action. And too much clutter only creates analysis paralysis, right? However, you do need to have key drivers, why you are in that trade, and things that you can use, I think, that are best as trend lines, especially horizontal support and resistance levels, I think are probably the most powerful. But regular trend lines might be your trigger for an entry into a trade. Just realize that price often likes to move back towards that breakout point for a retest. Significant moving averages. What do I mean by significant moving averages? Not all moving averages are significant for all stocks. Some stocks can honestly care less about the 100-day moving average when you look at the significance of it. Some stocks love unique moving averages like the 160-day or the 320-day or the 80-day. So my suggestion is to use alerts on your stocks that you follow for the moving averages that matter most. So you can keep your screens as clean as possible, and then you're alerted when those things happen. Key levels, look for round numbers. Round numbers are often just key pivot point areas for stocks. This can be price, percentage returns, market cap levels, multiples of IPO prices. I know that sounds weird, but it often works. And then, they're used as support and resistance and pivot levels, just as you would looking at a chart for horizontal support or trend lines. So directional in the money trade, you want to have strong directional conviction. It's going to be momentum driven, and it's going to have intrinsic value. So intrinsic value, for anybody that hasn't been trading options, basically just means that there's a value. If that option was to expire today, there's still a value to that option. All the time premium would be taken out, but you would still have a dollar value there. This really helps protect against falling implied volatility and theta decay, since the option is not all time premium, right? So, and these strategies can be used short-term or long-term. I'll show you one of each that we do here at the firm. So for like our weekend service, they're typically longer. We're looking for anything from about 3 months to 4 to 5 months out, and so they're a little bit longer swing trades. This was a trade that we recently did in Academy Sports and Outdoors. As you can see here, this green circle here is where we entered the trade. We kind of go through them on Friday, so this was where I was discussing about it with our trading team. It was breaking out of a downtrend, connecting this November high through April 22 peaks, and breaking out above this 200-day moving average. And it was also now above all major moving averages on all scales. So it's a very bullish setup. It also broke above this 39 level, which had been really capping price action, and just so happens to be 3 times IPO. Like I said, I don't know why it works, but it oddly enough does. Breaking above also 0% year over year level at the time. And short interest was up around 13.5% for the percentage of float. And the majority of shorts were underwater when you could just literally eyeball this chart. There's free platforms out there for you to look at short interest and price action. You can see where the shorts are building. And you could literally eyeball the chart and see that most of them were underwater. They were placing shorts down here and down here, and in these kind of moves lower. What are you going to do? This was kind of the theory is if you do get a rally here, this may be a position that shorts want to cut to limit losses, right? Because they're just like any other trader. They want to limit those losses. So it was something that could fuel a rally up to our target was $50. And then we also had a 10-day put call ratio in the 95th percentile. So what that was telling us is, there's more put buyers than there was call buyers. And then when actually looking at the option analysis of that, it was really telling us there's volatility ahead. Since ASO is a newer kind of issue, there isn't a lot of history to it. So it wasn't giving us the best direction on where the price action was going to go. But what you do is it's a puzzle. So you put the pieces to the puzzle together, and all the technicals were fairly bullish. So we took it from the long side. And then options were actually surprisingly still priced fairly cheap. They were in the 24th percentile at the time. So for that part of the market, that was fairly cheap. And, we knew we had some resistant levels, but, it kind of took them out nicely. As you can see, even when it got back above, it wanted to come back down and test them. Little hesitation, but then found more support here at this 42 area. And then it took off. We actually hit targets yesterday for 100% on yesterday's candle on this trade. And then, so now a little bit of a shorter term one that we use for in the money. We, kind of trade it's, 3 to 4 days to expiration. We were looking at PayPal the other day. So we entered in on, it was August 9th, while it was approaching this 8-day EMA moving average, so the exponential moving average. The drivers really for this trade were it was an underperformer, but it was breaking higher out of this long base and signaling a potential trend change. Recently it had blowout earnings, and really it was the first positive reaction in 6 quarters that it had. So even though the previous quarter it beat, it didn't have a positive reaction overall. So it was flagging in the 93.94, which also is a former pivot, like I said, from that long base area, and it was minus 50% year-to-date area. And then the IVs had come in after earnings as they typically implode. So on a percentile basis, it was in the 36th percentile. So all we were doing was targeting a quick move up to $100 or above. So the next day, we literally took part of the trade off for 50% as it moved up towards $100. And then we closed it at expiration. I believe the overall return on the trade was about 98%. So all we were doing was targeting that previous high from the earnings reaction off a nice bullish little setup here as it came into a confluence of support from a moving average and a long-term kind of resistance, or not a long-term, but a few-month resistance level that now could become support. Directional kind of at-the-money trades. We're going to be a lot more aggressive in these types of setups here. We are looking at earnings. We're looking at major conferences. We're looking at major news catalysts. So obviously we still have that strong directional conviction. But we're looking for consolidation breakouts from price action that had been consolidating, and we're expecting a volatility expansion on the move. So I got a couple trade ideas or trade examples to show you how this kind of works for us here at the firm. This was Abbott Laboratories. This trade actually came out in June, and it kind of went through July. So, but it was a good example, and I figured it was good to kind of share this one with you. It was around, there was a time that there was the baby formula news that was out there, but it was having a confluence of just multiple indicators that was telling us, hey, we can get to short this position. It can be a quick hit for us. Get in and get out. So this 80-day moving average, it recently failed at it. This moving average in the past had been significant in bull runs, and then now in the bearish move, it had been marking tops. It marked tops back in early January, and marked the top back in April. And so we were taking the opportunity here to saying, hey, it's failing again at this 80-day moving average. Not anybody's really watching that as much. And then it was kind of in this like little kind of strange little type of bear flag, right? You saw this consolidation of price. And once it broke through that in the 21 EMA, and it was an aggressive type of candle, we got short this stock. It also it's not shown on the chart here, but it was holding below and rejecting at the 100-week moving average, which was an area in 2016 that it had struggled to move above and often failed at that area when it was below it. So that was, I believe, in 2016 during the last significant kind of bear market for Abbott Laboratories. So that was an additional driver. So as soon as it broke below this 115 level, like I said, which had been previous support, we wanted to get short this. We bought the July 115 strikes. We have an in-house indicator that kind of gives us a little bit of a heads up on volatility. It's a volatility scorecard. That was ranking 84. But looking at open interest ratios, they were in the third percentile. You can pull this data from areas. You can kind of eyeball it in your option montage. A lot of people were very call heavy in Abbott at the time. And we knew from, charting it that it was vulnerable to pullbacks. So that's another reason why we took this trade. So what happened is we were able to kind of break down through this EMA, and you can see it quickly move lower with the rest of the market as well. That did obviously help the trade. We were targeting 103, so we took part of that trade-off down near 103. And then once it went back in this consolidation zone, we just wanted to kind of kill the trade. We didn't fully trust what was going to happen. Once they kind of go into that, Abbott's a pretty strong stock. You want to be able to move on from that. So we killed it. Overall trade was about 100%. So not as much as we want, but it was still a great trade. Another trade that we did just recently was on August 1st. It was a weekly option trade, so even shorter term. We took Timpane for the 16.5 strike on the August 5th expiration. We paid $1.07 for this. And the reason why we were taking this trade was it had recently doubled off of its May lows over here. And it was kind of slightly pulling back when you looked at an hourly chart on light volume to the 80-day moving average. And this was rolling right into the 30 billion market cap. And it was still just kind of trending nicely in this beautiful price channel. Short interest, though, had increased 50%, while shares had doubled. So new shorts were at a loss and on the position. And again, just like the previous one we talked about, a short covering rally could really kind of take hold here if they cut this position to control losses. Again, another that volatility scorecard that we have internally was an 85. So it was telling us, hey, volatility could still be in this. So we took the trade. We entered this trade here right on the open on that Monday, following this candle break on the short-term trend line and the bounce off that 21 EMA, and immediately got a nice move off of it. I believe in this service, we actually just run it right through expiration. So it went through expiration at closed out around 144% for us. Another thing that we do, and we kind of recently did during the bear market, was a way to play directionally for cheap. And what we do is we use debit spreads, and we do them out of the money. You don't have to, but it's a simple strategy that kind of helps you play out of the money contracts where you can kind of buy one contract, sell one contract. Again, you can play at the money, you can play in the money as well, and then sell that out of the money contract. Doesn't really matter. We just do it a little bit differently here. Here is a chart really kind of explaining what's happening if you haven't seen a vertical debit spread. You're buying this long call, you're selling this short call, and your break even is right about there. So you need to get a move to your break even level and then above, but you will be capping convexity at your short call level. But that works really great in markets where you're unsure. So like we've been in, that's something that was great. Now you would have rather had convexity running, but you don't always know that in advance. So you can place directional bets with less upfront capital. This allows smaller accounts to trade larger price securities like an Apple, an Amazon, a Google, that you might have been priced out of if you have a small account. So, you also have a higher probability of profit from this trade structure, since your break even is lower than from selling that out of the money strike against it. So you need less of a move in your direction for you to break even on this than an outright premium position would. Time decay is also a little bit muted. So it kind of helps you a little bit in staying into the position, since the theta decay is actually working for you on that call that you sold overhead. And additionally, stop losses are a little bit easier to manage because, if you just outright long premium, maybe a move against you would have been minus 40%. In this case, it might be minus 30%. So that will help you as well. So here's a quick example of this. We traded Mara, so Mara Digital Holdings. Obviously, people probably know if you've been trading at all, this thing has been on a tear. We entered a trade on 7/15 where we bought the 10 strike and sold the 12.5 strike in the August standard expiration. It was holding the gap up level from December 2020 right here. It was coming to that 21 EMA. And we saw this large positive volume. These spikes in large positive volume or negative volume often mark big pivot points. So we got long, and then again, the volatility scorecard that we use was ranking at 81. The put call ratio, the 50-day was in the 95th percentile, so there was a ton of puts out there that were bought to open. And the near-term peak put and peak call resided at the 10 strike level. So if we knew that we could get through that 10 strike, we really could get into a gamma squeeze. We literally took some of this trade off within a few days, and what helped was short interest was massive, is about 31%. I believe, let's see here, it looks like on the 19th, we literally took off half the trade. When we entered it on Friday, the 15th, it was around 35 cents, 36 cents. And we took that first half off at 250%. And then we closed it later on for a total of around 250%. But if you really wanted to let this final 50% run, since you already had a big gain in it, you could have been up anywhere up to about 700% on this trade later on if you just wanted to let it run into expiration here this week. And then finally, we have credit spreads. This is for people that are a lot more kind of conservative. You still have a directional bias here, and you're profiting from a wide range of outcomes, and you have cap losses. So you're only going to have losses the width of your strikes, and then time decay actually is your friend. So final chart here. Immediately we sold the September or the August 20 strike and bought the 18 strike for Pinterest here on 8/2 for about 27 cents. It was breaking out of a rectangle bottom out of a 2-month kind of consolidation there. It was bouncing at the minus 50% year-to-date level. It moved back above the 80-day moving average, which had been capping price since November 2021. And it moved above multiple short-term resistance levels. So I wasn't super confident that this would continue to rally, so we sold it instead. The implied volatility rank was around 70th percentile, and it was imploding. And then our proprietary volatility scorecard was around 42, so it was middling. So I didn't have confidence this would continue on. So as long as we held this through expiration, we were going to collect about 17%. And you can see here, this is basically what an IV crush is. What it's doing is it just kind of takes premium right out of that trade that you put on. And, now it's going to be expiring next to nothing. Today you could probably get out of it for about 2 cents. That is it for me today. Thank you so much for your time. We'd love to chat with you about your options trading. Come over to Schaeffer's Research. We have a bunch of free education there and individual option news. Give us a follow on Twitter and have a great day.
That's what it's all about. Definitely check it on out. I like how you walked through some of those trades right there and not doing too bad. And I'll definitely tell you guys, those were interesting to see those and some of those killer trades and not something small. So thank you for coming on today, Matthew, and we'll continue having you back on here on Benzinga.
All right. Have a good one, Mitch.